Right now, most Americans are focused on gas prices, rent, groceries, real, everyday pressures that hit immediately. But behind the scenes, there's a much bigger question looming over the entire U.S. financial system. One that almost nobody is talking about. Here it is, plain and simple. What happens when the country holding trillions tied to the U.S. dollar decides those dollars are no longer worth holding? China controls roughly $3 trillion in foreign reserves, much of it tied directly to the U.S. dollar, through U.S. Treasuries, dollar-denominated assets, and global trade settlements. Let that sink in for a moment. This isn't pocket change. This isn't some abstract accounting figure. This is enough financial weight to move markets, shake confidence, and force reactions at the highest levels of government. And here's the uncomfortable truth most people never hear. The power of the U.S. dollar depends far more on trust than most Americans realize. For decades, the dollar has been king. Oil is priced in dollars. Global trade runs on dollars. Foreign governments hold dollars because they believe the U.S. system is stable, predictable, and ultimately safe. That belief, more than military strength or political influence, is the real backbone of America's financial dominance. But confidence isn't permanent. And when it starts to weaken, the shift doesn't come with sirens. It happens quietly. And then very quickly. Here's the part that should make people pause. China doesn't need to attack the dollar in some dramatic headline-grabbing way. There doesn't need to be a press conference. There doesn't need to be a bold announcement. All it takes is a gradual change in behavior. Selling U.S. Treasuries slowly, reducing dollar exposure, settling more trade in other currencies, or redirecting reserves into assets like gold. No fireworks. No warning. Just pressure building beneath the surface. This isn't about China hating the United States. This is about leverage. When one country holds massive exposure to another country's currency and debt, it creates a pressure point. And pressure points sooner or later get tested. From an American perspective, this hits close to home. The dollar isn't just a global reserve currency. It's your purchasing power. It's your savings. It's the cost of everything this country imports. If global demand for dollars weakens, the consequences don't stay on Wall Street. They show up at the grocery store, at the gas pump, and in the housing market. Now, to be clear, this doesn't mean the dollar collapses tomorrow. That's not how systems like this fail. They erode. Slowly at first and then all at once. History shows that reserve currencies don't lose dominance because of one dramatic event. They lose it because the world starts quietly preparing for a future where that dominance is no longer guaranteed. So the real question isn't whether China can hurt the dollar. The real question is how much leverage holding $3 trillion actually gives them, and what happens if they ever decide to use it. That's where this story really begins. To understand why China is sitting on a mountain of U.S. dollars, you have to rewind a few decades. This didn't happen overnight. It was the result of a long, deliberate economic setup, one most Americans barely noticed at the time because, frankly, things felt good at home. In the late 1990s and early 2000s, the United States made a massive bet. The doors to globalization were thrown wide open. Manufacturing moved overseas. Cheap labor meant cheaper goods and higher corporate profits. On paper, it looked like a win. Store shelves stayed full, prices stayed low, and consumers didn't ask many questions about where everything was being made. China stepped directly into that opening. As American companies shifted production to China, especially after China entered the World Trade Organization in 2001, something fundamental began to change. The U.S. started importing far more than it exported. That growing trade imbalance meant one thing. Dollars flowed out of the United States and straight into China's hands. And when Chinese factories shipped goods to American consumers, they weren't paid in yuan. They were paid in U.S. dollars. Here's where the strategy comes in. Instead of pushing those dollars back into global markets, China recycled them. Those dollars were used to buy U.S. Treasury bonds, U.S. assets, and other dollar-denominated investments. In effect, China loaned the United States its own money back again and again. This wasn't accidental. For years, China tightly managed its currency through capital controls and direct market intervention, keeping it weak relative to the dollar. That made Chinese exports cheaper, more competitive, and extremely attractive to global buyers. Manufacturing surged. Trade surpluses expanded rapidly. Meanwhile, the United States benefited from cheap imports and low inflation, but quietly became dependent on foreign capital, particularly capital coming from China. Think about that dynamic for a moment. While American consumers were upgrading TVs and buying inexpensive electronics, China was stacking dollars like chips at a poker table. Not because they loved the dollar, but because the system rewarded them for holding it. Within a decade of WTO entry, the numbers were staggering. Trillions of dollars in foreign reserves. Trillions tied directly to the health and credibility of the U.S. financial system. And once you're holding that much exposure, you're no longer just a participant in the system. You're a stakeholder. This is where the power dynamic begins to shift. When one country consistently runs deficits and another consistently runs surpluses, the surplus country accumulates leverage. Not loud leverage. Quiet leverage. The kind that rarely makes headlines, but absolutely matters behind closed doors. China didn't wake up one day and decide to hoard U.S. dollars. The structure of global trade, U.S. policy choices, and decades of economic decisions effectively handed those dollars over. And now, after years of accumulation, the unavoidable question becomes sharper. What does China do when it's holding the financial IOUs of the world's largest economy? And what risks come with that power? That's where things start to get complicated. Here's where the conversation usually goes off the rails. People hear that China holds trillions tied to the US dollar and immediately picture a red button being pushed. Markets crashing, the dollar imploding overnight, total chaos. That's not how real power works. Real leverage is quieter, smarter, and in many ways far more dangerous. Let's get one thing clear right away. China can't just dump all its dollar holdings tomorrow without hurting itself. A sudden sell-off would crash bond prices, send yields soaring, and slash the value of China's remaining assets. That would be self-inflicted damage. But here's the part that actually matters. China doesn't need to sell everything to cause serious problems. Most of China's dollar exposure isn't sitting in cash. It's parked in U.S. Treasuries, agency debt, and other dollar-denominated assets. And that gives Beijing something extremely valuable: options. One option is slow liquidation. China can gradually reduce its treasury holdings month by month, quarter by quarter, without making headlines. No panic. No announcements. Just a steady increase in supply in the bond market. When bond supply rises, prices fall. And when prices fall, yields rise. Higher yields don't just hit Wall Street, they hit Main Street. Mortgage rates climb. Car loans get more expensive. Credit card interest spikes. The American consumer feels the pressure, even though nothing dramatic ever appeared in the news. Another option is diversification. China can take incoming trade dollars and redirect them elsewhere, into gold, commodities, strategic infrastructure projects, or non-dollar currencies. Every dollar not recycled into U.S. debt weakens global demand for U.S. financing. Again, no shock event. Just a slow shift in financial gravity. Then there's the trade settlement angle. And this one doesn't get nearly enough attention. If China settles more international trade in yuan or alternative currencies, fewer dollars move through the global system. And the dollar's dominance depends on constant usage. Reserve currencies don't collapse from direct attacks. They fade when the world slowly stops needing them. This is the part most people miss. China doesn't have to weaponize the dollar. It can simply stop supporting it. For decades, countries like China helped stabilize U.S. deficits by absorbing excess dollars and buying American debt. If that behavior changes, the United States faces a hard choice. Find new buyers for its debt, or rely more heavily on Federal Reserve intervention to keep the system functioning. Neither option comes without consequences for the dollar. And this is where financial leverage turns into geopolitical power. When one side knows the other depends on continued cooperation, the balance shifts. Trade negotiations, sanctions, technology restrictions, even military posturing, all of it unfolds under the shadow of financial dependency. So the real danger isn't a dramatic sell-off splashed across headlines. The real danger is a future where China quietly steps back, lets the math do the work, and allows pressure to build inside the US system. Slowly, steadily, and mostly unnoticed. And once that pressure reaches a certain point, it doesn't matter how confident the headlines sound. The system starts reacting on its own. Here's the part that almost never makes it into mainstream conversations. And honestly, it's the most uncomfortable truth of all. The US dollar isn't backed by gold, oil, or military power by themselves. It's backed by belief. And belief is fragile. The United States can run massive deficits year after year because the rest of the world is willing to finance them. Foreign governments buy US debt. Global institutions hold dollars. International trade keeps settling in dollars. As long as that cycle continues, the system holds together. But the moment belief begins to crack, the math turns ugly. Fast. The arrangement is simple. The United States creates dollars. The world absorbs them. That deal has defined the global financial system for decades. But what happens when major players start questioning whether that arrangement still works in their favor? Here's the vulnerability. The US needs constant foreign demand for its debt to keep interest rates manageable. If that demand weakens, even slightly, the Federal Reserve faces a brutal choice. Allow rates to rise and risk choking the economy, or step in and buy the debt itself through balance sheet expansion, effectively monetizing the shortfall. Either path puts pressure on the dollar. This is where China's position becomes especially important. When a major holder of US debt changes behavior, markets don't collapse overnight. They signal. Treasury auctions show softer demand. Yields creep higher. Volatility increases. It's not a crash. It's stress fractures forming beneath the surface. And let's be honest. The US debt load is already enormous. Trillions in obligations, growing every year. The system only works as long as refinancing stays cheap and confidence remains intact. That margin for error is thinner than most people realize. There's another vulnerability that rarely gets discussed. Complacency. Because the dollar has dominated for so long, policymakers often assume it always will. But history doesn't support that assumption. Every dominant currency eventually faces challenges. Not because it suddenly collapses, but because global systems evolve. Here's what really matters. China doesn't need to replace the dollar to weaken it. It only needs to make alternatives more attractive. Bilateral trade agreements. Regional payment systems. Commodity pricing outside the dollar. Each step chips away at exclusivity. And once exclusivity fades, demand fragments. Fragmented demand is deadly for a currency built on scale. For the average American, all of this sounds abstract, until it isn't. A weaker dollar means higher import costs, higher energy prices, less purchasing power, and long-term pressure on wages that never quite catch up. So the vulnerability isn't some hidden financial weapon. It's the structure itself. A system that works brilliantly, right up until belief shifts. And when belief moves, it doesn't send a warning. It just leaves. Here's the thing about financial shocks. They never come out of nowhere. They're the result of pressure building quietly for years, like a fault line slipping inch by inch, until something small finally lights the fuse. The US dollar is no different. The pressure is already there. What matters now is what triggers the reaction. One possible trigger is a serious geopolitical escalation. Trade wars hardening into financial wars. Sanctions expanding. Technology restrictions tightening. As relations between the United States and China grow more strained, China has a strong incentive to reduce exposure to US assets. Not as retaliation, but as risk management. And when the world's second-largest economy starts treating US debt less like a safe haven and more like a risk factor, markets take notice. Another trigger comes from inside the United States itself, and this one is about credibility. Ballooning deficits, political gridlock, or a visible loss of fiscal discipline can shake foreign confidence. Treasury auctions begin to soften. Demand weakens. Yields rise. Rising yields force difficult policy choices, and difficult choices tend to expose cracks faster than stability ever does. This isn't ideological. It's mechanical. Then there's the inflation wildcard. If inflation resurges, the Federal Reserve walks straight into a policy trap. Raise interest rates to defend the dollar, and risk slowing the economy or triggering a recession. Cut rates to support growth, and risk undermining confidence in the currency itself. Either direction introduces uncertainty, and uncertainty is exactly what long-term foreign holders pay attention to. There's also a quieter, less obvious trigger, but potentially one of the most powerful: coordination. China doesn't need to act alone. If multiple countries begin diversifying reserves at the same time, slowly, methodically, the effect compounds. No single move looks dramatic. No headlines scream crisis. But together, those decisions gradually pull the center of gravity away from the dollar. Another scenario is a liquidity event, a global shock where everyone needs cash at once. Think financial crisis, pandemic-style stress, or systemic banking instability. In moments like that, countries reassess what they're holding and why. And if confidence in U.S. assets wavers during a crisis, selling accelerates, not because of strategy, but because of necessity. Here's the key point: the dollar doesn't need a collapse to lose power. It only needs instability, volatility, uncertainty. Once those enter the system, long-term holders start thinking short-term. And once long-term holders stop behaving like long-term holders, the system begins to change. None of these scenarios require a dramatic announcement. No end of the dollar speech. No countdown clock. Just a series of rational decisions made under pressure. That's how financial shocks actually happen. And when they do, the reaction is almost always faster than the warning. If the dollar loses strength, the effects don't stay neatly contained inside financial markets. They spill out quickly and they touch everything. That's the part most people underestimate. A weaker dollar isn't just a currency story. It's a global reset of incentives. For the United States, the first impact is purchasing power. Imports become more expensive. Energy, electronics, raw materials. Anything priced globally starts costing more dollars. That pressure feeds inflation even if demand doesn't change. Wages lag. Savings lose real value. And the idea of a permanently strong consumer begins to crack. Then there's borrowing. The U.S. government rolls over trillions of dollars in debt every year. If confidence in the dollar weakens, lenders demand higher yields to compensate for risk. Higher yields mean higher interest costs. Those costs don't vanish. They squeeze federal budgets, crowd out other spending priorities, and increase pressure on policymakers to rely more heavily on money creation. Once that feedback loop takes hold, reversing it becomes increasingly difficult. Globally, a weaker dollar reshapes power. Countries holding large dollar reserves absorb losses. Trade relationships adjust. Commodity exporters rethink pricing and risk. And alternatives, regional currencies, bilateral trade agreements, non-dollar payment systems, stop being theoretical and start becoming practical. Here's the part most people miss. The dollar's dominance functions like a public good. The United States benefits the most from it, but the rest of the world helps sustain it. When that arrangement begins to feel unbalanced or risky, countries don't revolt. They adapt. And adaptation is quiet. It looks like reserve diversification. New trade invoicing rules. Less exposure here, more exposure there. Over time, the dollar shifts from being the default to being one option among many. That's how influence fades. For China, a weaker dollar cuts both ways. It reduces the value of existing holdings, but it also weakens U.S. financial leverage, lowers the barriers to alternative trade systems, and accelerates a multipolar financial order. That isn't a sudden pivot. It's a long game Beijing has been preparing for, methodically, over years. For everyday Americans, this is where it becomes personal. Cost of living, job stability, retirement savings. The dollar isn't an abstract idea. It's the unit everything in your life is measured in. So this isn't about predicting collapse. It's about recognizing transition. Reserve currencies don't disappear overnight. They gradually share the stage, until one day, they're no longer standing at the center. The real question isn't whether the dollar disappears. It's how much ground it gives up, and how prepared the United States is when that happens. If you found this analysis useful, share your perspective in the comments. And if you value calm, clear breakdowns of the forces shaping the global economy, consider subscribing.